Picture this. December 1914. You are standing in the vaulted main hall of the Bank of England on Threadneedle Street, London, and the air smells of coal smoke and ledger paper. The mahogany desks are still. The clerks are still. The gold vaults beneath you hold what remains of the largest empire on Earth's monetary reserves, and the number is falling. It has been falling since August. Every morning, the deputy governor's first act is to calculate how much gold crossed the Atlantic overnight, not transported but legally transferred. Settlement on pre-war American loans, dollar bonds. Commercial obligations that matured in peacetime and became due in a war that Britain did not yet know how to finance. The telegrams from New York arrive in cipher. The decoded figures are written in pencil, not ink. No one wants a permanent record of exactly how thin the line has become. Outside, on the street, the queues for the recruiting offices stretch around the block. The newspapers say the war will be over by spring. Inside the bank, the men with the actual numbers know that spring depends on something the newspapers cannot print. The gold has to hold. This isn't dramatized history. This is documented in the Bank of England's own internal correspondence, in the Cunliffe Committee records of 1918, and in the U.S. Treasury archives covering Secretary William McAdoo's wartime interventions. The forensic record is specific and more than a little disturbing. By December 1914, Britain's gold reserves had fallen from £164 million to under £100 million. That was a 39% decline in 4 months. McAdoo closed the New York Stock Exchange on July 31, 1914, the longest closure in the exchange's history at that point, specifically to prevent gold-denominated bond redemptions from draining UK reserves across the Atlantic at a rate the Bank of England could not survive. In August 2007, Northern Rock experienced the first British bank run in 141 years. It lasted 4 days before the government intervened. In 1914, the Bank of England was running a slow-motion version of the same event, across a 4-month timeline, measured in gold shipments instead of queuing depositors. The mechanism was identical. The institutional stakes were an order of magnitude larger. Here's the thing that keeps me up at night. The official story of British war finance is a story of national sacrifice and democratic resolve. Bonds sold to the public, taxes raised, an empire that paid its way. The forensic record tells a completely different story. The survival of Britain's monetary system in the autumn and winter of 1914 depended on a single private institution in New York, a banking house that had no democratic accountability to either country that negotiated its access fee in private. That became structurally identical to Britain's war effort, and that extracted terms the British Treasury accepted because there was no alternative. The question is not whether a country at war will find a financial lifeline. The question is, who holds the other end of the line, and what they charge for holding it. I went through the forensic record on British war finance from 1914 to 1917, the Federal Reserve Board archives, the Morgan Bank internal correspondence published by Ron Chernow, the British Treasury memoranda reviewed by Kathleen Burke in her 1985 study of Britain, America, and the sinews of war. By the end of this video, you will know exactly how the Bank of England's reserve crisis in late 1914 was engineered and then resolved. You will know how J.P. Morgan's appointment as sole British purchasing agent in January 1915 transformed a private bank into a mandatory infrastructure node for an entire empire's survival. You will know what that structural dependency cost Britain in negotiating power at Versailles and in the post-war financial settlement that ended sterling's global dominance. And you will know the repeating mechanism that this case reveals, because this is not the only time a private institution has become too valuable to the state to be regulated by it. Stick with me. Before we open the forensic record on 1914, let me give you the analytical framework that makes this case readable. What happened to Britain and J.P. Morgan is not a story about one unusual war or one unusually powerful bank. It is an example of a mechanism that appears across financial history with a consistency that the forensic record cannot explain away. I call this the indispensable creditor mechanism. The mechanism has 3 stages, and they always follow in the same sequence. Stage 1 is reserve depletion. A sovereign state, usually under military or political stress, exhausts its ability to finance its obligations through domestic means. The depletion is often rapid, Reserves that looked adequate in peacetime prove insufficient when the state must simultaneously finance military operations, service pre-war foreign debts, and maintain its currency's convertibility. The depletion creates urgency, and urgency eliminates negotiating leverage. Stage 2 is private rescue. A private institution, usually a bank or banking consortium, steps in with the financing capacity the state cannot provide. The institution's rescue is genuine, not fraudulent. The state genuinely cannot survive without it. But the rescue is not charitable. The institution extracts terms, exclusive access, regulatory protection, operational control over purchasing flows, commissions on transactions, or some combination. The terms are accepted because the alternative is default, collapse, or military defeat. The state is not coerced in any formal sense. It simply has no other option, and the institution knows it. Stage 3 is structural dependency. Once the private institution becomes the mechanism through which the state finances its survival, its fate and the state's fate become aligned. The institution cannot be regulated aggressively, because regulation would compromise the financing it provides. It cannot be investigated publicly because investigation would signal instability to the very markets whose confidence the state requires. The institution becomes, in a precise and documented sense, too important to the state to be treated as a private actor. It operates inside the state's survival requirements while remaining formally outside its accountability structures. The forensic record shows this mechanism in operation before 1914, and it shows it operating after 1914. But the British case between August 1914 and April 1917 is the most completely documented instance in the entire history of Anglo-American finance. Every stage is on the record. The dates are specific. The numbers are exact. The named individuals made decisions that the primary sources preserve in full. Here is what that mechanism looks like when you pull it apart case by case. Number 1 is the most obvious, and yet it's the one most institutions repeat. The gold reserve crisis of August to December 1914 was not caused by the war itself. It was caused by the collision of a wartime emergency with a pre-war financial architecture that had never been designed to survive one. Here is the specific sequence. On July 23, 1914, Austria-Hungary issued its ultimatum to Serbia. Within 72 hours, European capital markets began moving. Foreign holders of sterling-denominated securities started liquidating, converting sterling proceeds to gold, and shipping the gold home. This was legal. It was rational. It was catastrophic for the Bank of England. The Bank of England's gold reserve on July 31, 1914, stood at approximately £164 million. Under the Bank Charter Act of 1844, the bank was required to hold gold backing for every pound note it issued above the £14 million fiduciary issue limit. The legal minimum was not a guideline, it was a statutory floor. Breach it and the bank was legally prohibited from issuing currency. Legally prohibited from issuing currency in wartime meant no ability to fund the government, no ability to pay the army, no ability to service any obligation. The entire British war effort depended on the bank remaining above a number written into law 70 years earlier by a parliament that had never contemplated what a European general war would do to London's gold position. By the second week of August, the bank had already lost £30 million in gold. The rate of outflow was accelerating. Here's the brutal math. Between August 1st and December 1, 1914, Britain's gold reserves fell from £164 million to under £100 million. That is a 39% reduction in 122 days. The average daily outflow was approximately £525,000 in gold. At that rate, the bank would have breached its legal minimum before the end of January 1915. The war would have been 6 months old. The Western Front had not yet stabilized into trenches. Britain would have faced monetary collapse before the first major offensive. The documented response was William McAdoo's decision to close the New York Stock Exchange on July 31, 1914. McAdoo, serving as Woodrow Wilson's Treasury Secretary, understood that open trading would allow the immediate liquidation of the approximately $1.5 billion of American securities held by British investors. Those liquidations would have generated gold settlement demands that the Bank of England could not meet. The exchange stayed closed for 4 months and 12 days, reopening on November 28, 1914, the longest closure in its history at that point. The official story of that closure is that it was a prudent measure to prevent financial panic. The forensic record tells a completely different story. The closure was specifically engineered to give the British monetary system time to construct an alternative financing mechanism before the gold ran out. Without McAdoo's intervention, the indispensable creditor mechanism would have had no room to operate. Britain would have defaulted before it could find a rescuer. Same mechanism, same urgency, same outcome created by the same legal architecture colliding with a crisis it was not built for. Number 2 is where the pattern gets counterintuitive. J.P. Morgan's appointment as sole British purchasing agent on January 15, 1915, was not a wartime improvisation. It was the formalization of a structural dependency that the Morgan firm had been building since the 1890s. The background matters. J.P. Morgan & Company had been the primary underwriter of British government securities in the American market since 1900. When the Boer War required external financing, Morgan sold British bonds to American investors. When British Railways needed capital, Morgan arranged it. The relationship between the Morgan firm and the British Treasury was not a transactional one. It was an institutional bond, built over 15 years of documented cooperation that gave Morgan information about British financial conditions that no other American institution possessed. By October 1914, Morgan partner Henry Pomeroy Davison traveled to London for conversations with Chancellor of the Exchequer David Lloyd George and Bank of England Governor Walter Cunliffe. The conversations were not exploratory. By that point, Britain had already concluded that it needed American financial infrastructure to survive the war. The question was the terms. Here's what the forensic record shows. The Morgan contract signed on January 15, 1915 gave J.P. Morgan & Company exclusive authority to purchase all war materials for Britain and France in the United States market. Every rifle, every shell casing, every pound of cordite, every piece of industrial machinery required for the war effort had to pass through Morgan's purchasing operation. The commission rate was 1% of the value of all purchases. That number requires a full stop. By 1917, J.P. Morgan had channeled $3 billion in British and French war purchases through its accounts. At 1% commission on $3 billion, the Morgan firm earned $30 million in purchasing commissions alone. In 1915 terms, $30 million was approximately $740 million in 2024 purchasing power. And the commission was only one income stream. Morgan also earned on currency exchange operations, on the bond underwriting required to finance the purchases, and on the credit facilities extended to Britain when its dollar balances ran short. The documented counterintuitive element is this. Morgan's commission rate of 1% was publicly defended by both the British and American governments as modest, even selfless. The firm's representatives testified before the Senate Munitions Investigation Committee in 1936, chaired by Senator Gerald Nye of North Dakota, that 1% represented an unusually low fee for the scale and complexity of the purchasing operation. Morgan partner Thomas Lamont argued that 1% on a $3 billion program was a sacrifice compared to normal commercial rates. Senator Nye's investigators examined the same $3 billion figure and concluded that the Morgan commission structure, combined with its bond underwriting fees and exchange operations, produced total war-related income of approximately $50 to $60 million between 1915 and 1917. The committee's evidence was specific enough that Morgan's counsel could not dispute the total. He disputed only the characterization. The pattern confirmation is precise. Stage 2 of the indispensable creditor mechanism produced a private institution earning the equivalent of $50 to $60 million, $1915 from an exclusive government contract. The exclusivity was not negotiated aggressively by Britain. It was offered, because the alternative, building a British government purchasing apparatus from scratch in a neutral country within 90 days, was not operationally possible. Number 3 is the one nobody talks about. The Bank of England's reserve crisis was solved not by gold shipments, but by an instrument that should not have worked at all. And the fact that it worked reveals something specific about how monetary authority functions under existential pressure. On August 6, 1914, with war 5 days old and gold already flowing out of London, Chancellor Lloyd George and Bank Governor Cunliffe enacted what the forensic record calls the Currency and Bank Notes Act 1914. The act authorized the Treasury to issue paper currency notes. the so-called Bradbury pounds, named after the Treasury Permanent Secretary John Bradbury, whose signature appeared on them, backed not by gold, but by government credit. This was, in formal monetary terms, a suspension of convertibility. Britain left the gold standard not through a public announcement, not through a parliamentary debate, but through technicality that allowed it to claim it had not left at all. The Bradbury notes circulated alongside gold sovereigns. Gold remained legally available for international settlement, but domestically, the Bank of England was no longer constrained by the gold ratio the Bank Charter Act required. Here's the brutal math. Between August 1914 and January 1915, the Treasury issued £45 million in Bradbury currency notes. The Bank of England's note circulation held steady. The gold reserve, which had been falling at £525,000 per day, stabilized, not because the outflow stopped, but because the domestic monetary base was no longer tied to the gold that was leaving. The named individuals who understood what had actually happened were remarkably few. John Maynard Keynes, then a 31-year-old Treasury official, wrote a memorandum on August 3, 1914, the day before the war began, advising that Britain could sustain its war finance without significant gold loss if it managed domestic confidence correctly. His advice was rejected initially, then adopted in substance within 2 weeks. John Bradbury, whose name went on the notes, understood that the convertibility fiction was necessary to prevent panic, but that it was a fiction. His private correspondence with Lloyd George shows that both men knew the notes were not gold-backed in any meaningful sense. The public did not know. The foreign exchange markets did not immediately price it. The fiction held long enough for the Morgan relationship to be formalized. The official story is that Britain maintained the gold standard throughout the war. The forensic record tells a completely different story. Britain suspended gold convertibility domestically within the first week of the war through an instrument specifically designed to avoid announcing that it had done so. The monetary system held not because the reserves were adequate, but because the named individuals in Treasury and the bank chose to obscure the reserves' inadequacy long enough to arrange private rescue. Same mechanism. The institution holds because the people who know the truth do not publish it until after the crisis has passed. Number 4 is where the structural dependency becomes visible in the primary sources. By early 1916, J.P. Morgan's role in British war finance had expanded far beyond purchasing agent. The Morgan firm was, in practical terms, managing the dollar exchange rate for the British pound, and the British government knew it. Here's the specific documented sequence. Sterling's exchange rate against the dollar was pegged at $4.76 per pound throughout the war. The pre-war parity. Britain's Treasury and Morgan both knew this peg required constant intervention. Every time British gold or securities were insufficient to cover the dollar gap, Morgan would buy sterling on the open market, using its own capital, to prevent the rate from falling. A falling rate would signal financial weakness. A signal of financial weakness during wartime could trigger the exact run on sterling that the Bank of England's declining reserves made it structurally unable to survive. The forensic record, specifically the Morgan firm's internal records published in Ron Chernow's 1990 biography of the Morgan dynasty, shows that by mid-1916, Morgan had committed over $100 million of its own capital to sterling support operations. The firm was, in the precise sense of the term, making markets in British sovereign credit. Here's the brutal math. In January 1916, sterling's true market rate, absent Morgan intervention, was estimated by Federal Reserve Board economists at approximately $4.50 to $4.55 versus the $4.76 peg. The gap of 21 to 26 cents per pound may appear modest. It was not. Applied to the annual volume of British dollar transactions, a rate at $4.50 instead of $4.76 would have increased Britain's annual dollar financing costs by approximately $150 million. Britain's entire foreign exchange reserve in January 1916 was approximately $500 million. The Morgan peg operation was the difference between a reserve that could last 3 years and one that would last 18 months. Thomas W. Lamont, the Morgan partner most directly responsible for the peg operation, documented his conversations with British Treasury official John Maynard Keynes in letters preserved in the Harvard Business School archives. Lamont's position was consistent and specific. Morgan's continued intervention in the sterling market required continued exclusive access to British war purchasing contracts. The dependency ran in both directions. Britain needed Morgan to hold the rate. Morgan needed the purchasing contract to justify holding the rate. This is stage 3 of the indispensable creditor mechanism, rendered in primary source correspondence. The private institution and the sovereign state had, by January 1916, constructed a bilateral dependency in which neither party could survive the other's failure. That condition is not an accident. It is the natural endpoint of the mechanism. Once the state accepts the private institution as its financial infrastructure, the institution's interests become the state's interests, not through conspiracy, through documented contractual alignment. Number 5 is the one that illuminates why the mechanism ends the way it always ends. America's entry into the war on April 6, 1917, immediately changed the structural relationship between J.P. Morgan and Britain in ways that had permanent consequences for the post-war monetary order. Here's the specific sequence. On October 15, 1916, Federal Reserve Board Governor William Harding issued a public statement warning American banks that it was not in the interest of this country to continue extending credits to belligerent governments, referring specifically to Britain and France. The statement was not binding. It was a warning. It produced immediate effect. American lending to Britain fell 40% in the 90 days following the Harding statement. Morgan's ability to place British Treasury bills with American investors collapsed. By January 1917, J.P. Morgan partner Dwight Morrow wrote internally that Britain's dollar reserves would be exhausted by June 1917 if American lending did not resume, not reduced, exhausted. The same reserve crisis that had driven the 1914 gold depletion was repeating at a higher dollar magnitude. Britain was spending approximately $75 million per week in the United States. At that rate, and with American credit markets closed by the Federal Reserve's warning, the timeline was explicit. Here's the brutal math. Britain's liquid dollar reserves in January 1917 stood at approximately $470 million. At $75 million per week in American spending, reserves would reach zero by the last week of July 1917. The war's 4th year would have begun with Britain unable to pay its American suppliers. The American entry into the war on April 6, 1917, transformed this crisis into its opposite. The U.S. government began lending directly to Britain and France under the Liberty Loan program. The first British government loan from the U.S. Treasury was $200 million, extended within 30 days of American entry. The rate was 3.5% per annum. American private credit at that point was demanding 5% or more when it was available at all. J.P. Morgan's role did not disappear. The firm retained its purchasing agency contract until the armistice in November 1918, but the structural dependency shifted. Britain was no longer dependent on a private institution for its monetary survival. It was dependent on the U.S. government. The terms of that government dependency, not Morgan's commission structure, are what shaped the Versailles Peace Conference and the post-war financial settlement. The documented outcome: the U.S. government extended approximately $4.3 billion to Britain during the war, at interest. Britain's dollar debt to the American government at armistice was larger than its total gold reserves. The debt was not forgiven. It was renegotiated twice. Finally settled in the Balfour Settlement of 1923, extended to a 62-year repayment schedule. And Britain made its final payment on the First World War American debt on December 31, 2006. The indispensable creditor mechanism, once activated, does not terminate at the end of the emergency. It terminates at the end of the debt. 92 years after the Bank of England's gold reserves began their August 1914 decline, the last payment cleared. Same mechanism, same structural dependency. The timeline simply runs longer than any individual involved in the original crisis lived to observe. Number 6 is the pattern confirmation that closes the forensic record. The transition from Morgan dependency to U.S. government dependency was not merely a financing substitution. It was a transfer of monetary authority that neither Britain nor the United States fully recognized at the time. The forensic record viewed from the 1945 Bretton Woods Conference and the 1971 Nixon shock shows the 1914 to 1915 period as the precise moment when the Anglo-American financial relationship was structured in a way that made sterling's eventual subordination to the dollar mathematically inevitable. Here's the specific documented mechanism. The Cunliffe Committee, established in 1918 to examine British post-war monetary policy, was chaired by Bank of England Governor Walter Cunliffe, who had personally managed the 1914 reserve crisis. The committee's report, delivered in August 1918, recommended that Britain return to the gold standard at the pre-war parity of $4.76 as rapidly as possible after the armistice. The recommendation was unanimous. The reasoning was restoration of British monetary prestige. Here's the brutal math. Returning to $4.76 parity required Britain to deflate its domestic price level to 1914 conditions. By 1920, British prices were 65% above 1914 levels. Achieving $4.76 parity required a deflation of approximately 40% from peak prices. John Maynard Keynes, in his 1925 pamphlet, The Economic Consequences of Mr. Churchill, calculated that the overvalued pound was pricing British exports out of world markets at a rate that would produce 10% unemployment and systematic industrial decline. He was correct. Britain's unemployment rate stayed above 10% from 1920 through the entirety of the 1920s. Churchill, as Chancellor of the Exchequer, returned Britain to gold at $4.76 in April 1925. The decision was documented by both the Treasury and the Bank as primarily a matter of financial prestige, a signal that Britain had repaired its wartime monetary compromises. The forensic record shows that the actual consequence was the opposite. The overvalued pound accelerated the transfer of international financial primacy from London to New York that the wartime Morgan dependency had initiated. The mechanism is a straight documented line. August 1914 Reserve Crisis, Private Rescue, Structural Dependency, U.S. Government Dependency, Dollar-Denominated War Debt Cunliffe Committee, Overvaluation Recommendation. Churchill's 1925 return to gold at wrong parity. Sustained deflation, structural industrial decline. Sterling's 1931 departure from gold Bretton Woods in 1944, formally establishing dollar primacy. And in 2006, the final repayment of the debt the Bank of England could not avoid in December 1914. J.P. Morgan did not destroy the British Empire's financial primacy. The indispensable creditor mechanism did. Morgan was simply the institution available and willing to execute Stage 2, when Stage 1 had run its course. Same mechanism, same sequence, same outcome. A sovereign state under existential pressure exhausts its domestic financing capacity. A private institution with the required scale steps in. The terms are accepted because there is no alternative. The dependency becomes structural. The state's survival requirements and the institution's commercial interests align permanently. And the debt incurred to survive the crisis shaped the post-crisis order far longer than anyone who negotiated it remains in a position to observe the consequences. The modern parallel is not difficult to locate. In March 2023, when Silicon Valley Bank failed in 36 hours, the U.S. Federal Deposit Insurance Corporation and Treasury Department moved within 48 hours to guarantee all deposits, including those above the statutory $250,000 insurance limit. The guarantee required no congressional authorization. It required a systemic risk exception determination. The documented rationale was that SVB's depositor base, composed heavily of venture-backed technology companies, was too concentrated in the American innovation economy to permit uninsured depositors to absorb losses. 93% of SVB's $175 billion in deposits were uninsured. The systemic risk exception was granted. The uninsured deposits were made whole. The precedent extends the logic of the indispensable creditor mechanism in its reverse form. The institution is not rescuing the state is rescuing the institution. The structural alignment of private and sovereign interests is identical. The direction of rescue has changed. The mechanism has not. Drop it in the comments if you think the relationship between central banks and private finance has become structurally indistinguishable from what it was in 1914. I read every single one. Subscribe to The Money Architect. This channel examines how money, power, and systems have interacted across history, the documented evidence, the real outcomes, so you can read the situation before it reaches you.